When you run a business, you need to evaluate the financial performance of that business. This way, you know where you stand and can make intelligent business decisions. And then a logical question arises. How do you evaluate the financial performance of a company? How do you determine whether a company was profitable over a certain period of time? How do you know if a business has had a positive cash flow from operations or what the value of their assets was compared to the value of their liabilities at a certain point in time? Whether it's the business owners, creditors, or anyone else who has vested or potential interest in the company, the primary way for these stakeholders to evaluate the company's performance and financial condition is through review of company's financial statements. Financial statements are the tool by which accounting information is communicated to business stakeholders. Financial statements report on the performance of the business over a specific period of time, as well as its financial position at a certain point in time. All the entries recorded in the system during the accounting period accumulate within the accounts, and the resulting total balances of these accounts are then reflected on financial statements. Today, we will go over the two main financial statements, income statement and the balance sheet. Let's get started. Income statement, also known as profit and loss, measures the company's financial performance and reports on its profitability over a certain period of time. This statement lists all revenue and expense accounts and their respective balances, and then reports net income or loss based on the balances reflected in these accounts. Take a look at this income statement, also known as profit and loss. Do these accounts and balances look familiar? This is the income statement for our hypothetical consulting firm that was created based on the 10 journal entries that we made earlier in the lesson. Let's take a look at the structure of this statement. Every financial statement will have 3 important lines within its heading that will reflect the following: name of the company, name of the financial statement, and the time period that this statement covers. In our case, the name of the company is Hypothetical Consulting Firm. Name of the statement is Profit and Loss. And the time period is January through December of 2021. It's an annual income statement. Time period is a very important concept when it comes to financial statements. Income statements report results of operations over a certain period of time. Let's move on and go over the main elements of our income statement. Income statement first lists income accounts on top. It then provides total income based on the sum of balances in all the income accounts. In our case, we only have one income account, which is consulting income. So our total income is equal to our consulting income. Hopefully, this $5,000 consulting income balance seems familiar. It's based on a journal entry to recognize consulting income that we booked while going through our 10 hypothetical business transactions. Since it was the only entry to book income in 2021, this was also the total balance that accumulated in our T account and subsequently reflected on the profit and loss report. In our example, we're dealing with a service business that does not have cost of goods sold. If cost of goods sold would be involved, it would be listed below total income. You would then have a gross profit line, which would be the difference between total income and cost of goods sold. A prime example of activity that would be reflected in cost of goods sold account is when a merchandising business carries inventory. At the time the business would sell that inventory, the cost of items sold would be transferred from the inventory account to cost of goods sold account. In our case, there is no cost of goods sold or gross profit lines. So after total income, our P&L goes on to list all the expense accounts and their respective balances. In our case, there are 3 expense accounts with balances that are based on several journal entries that were booked in December of 2021. Next, expenses are totaled, and then a difference is taken between total income and total expenses. You will then get either a net income or net loss, depending on whether your number is positive or negative. Our total income is $5,000, and our total expenses are $3,640. So our net income comes to $1,360. Based on this, we're profitable for the year. We made a total profit of $1,360. And this is how the income statement, also known as profit and loss, reports the result of operations for a business. Next, we'll discuss the balance sheet. Balance sheet is a statement that reports on the financial position of a company at a certain point in time. Take a look at our balance sheet, that was prepared based on the 10 journal entries that we booked earlier, based on the transactions for our hypothetical consulting firm. We have the heading on top, which is comprised of 3 lines. Name of our company, which is hypothetical consulting firm. Name of the report, which is balance sheet, and the date as of which the balance sheet is prepared. Make sure to distinguish how the date reflected on the balance sheet is different from the income statement, which reports on operations over a certain period of time. Balance sheet reports on a financial position of a business on a certain date, not over a period of time. The balance sheet lists assets, liabilities, and equity accounts of a company and their respective balances as of a certain date. It's like a snapshot of a business at a certain point in time. The individual accounts of each category add up within their respective groups. From this, we get 3 group totals: total assets, total liabilities, and total equity. The most important point here is that total assets must always equal to the sum of total liabilities and total equity. Hopefully, it rings a bell that this statement resembles our accounting equation that was introduced earlier. As you recall, the accounting equation states that assets equal liabilities plus owner's equity. So the balance sheet presents the assets of the company as well as the claims against those assets. There are 2 types of claims against the assets of the company. First category are the liabilities, which are claims by creditors against the assets of the company. The second type is owner's equity, which are residual claims of owners against the assets of the business. And based on the accounting equation, total assets must equal total claims on those assets. Let's move on and go over all elements of the balance sheet for our hypothetical consulting firm. Top of the balance sheet reflects the assets section. The assets section is split into current assets and non-current assets. Current assets are either cash or assets that are expected to be converted to cash within the next year or the next operating cycle. The reason current assets are grouped and reported in a separate subsection is that someone who evaluates the balance sheet can right away determine what portion of company's assets is comprised of liquid assets. In our case, current assets are comprised of the following: cash, with the balance of $4,330, and accounts receivable with the balance of $4,000, so the total current assets are $8,330. Our next section is fixed assets. As you recall, we booked 2 entries for the following purchases of fixed assets: computer equipment for $1,800 and furniture and fixtures for $2,700. Based on this, our total fixed assets come to $4,500. Because these items are expected to benefit the company for a number of years, they were not expensed. Rather, they were put on the balance sheet as assets, and they will be depreciated over time. The next asset reflected on our balance sheet is the $2,000 security deposit that was part of our payment when we signed the lease. As you may remember, we signed a lease for office space in December and made a payment for $4,000. That $4,000 payment comprised of the following: a $2,000 current month rent payment, which was expensed to rent and went to the income statement, and a $2,000 payment for security deposit that is expected to be repaid at the end of the lease. So this is an asset. This portion of the payment made its way to the balance sheet under the account type of other asset. Our total assets are $14,830. Let's move on and take a look at our liabilities. Just like assets, liabilities are split into current liabilities and non-current or long-term liabilities. Current liabilities are expected to be satisfied within the next year or the next operating cycle. Our current liabilities are comprised of accounts payable of $2,700 and credit cards, payable of $1,270. The transactions that affected the balance of accounts payable were the $1,800 purchase of computer equipment and the $2,700 purchase of furniture. Since the $1,800 portion of this balance was paid to the vendor before the date of the financial statements, our ending balance of accounts payable is $2,700. The balance in the credit card's payable account comes from the journal entry that we booked for professional publications purchase in the amount of $1,270. Total current liabilities come to $3,970. Under long-term liabilities, we have a loan payable of $5,000. As you may recall, this is the loan we had to take to continue operations. Our total liabilities come to $8,970. Now we get to the equity section, which is the owner's residual interest in the business. The first item in our equity section is owner's contributions. The balance comes from our very first transaction, where the owner contributed $4,500 to the business. We booked this transaction with a debit to cash and a credit to owner's contribution, which is an equity account. Since net income flows into equity, net income is the other account that comprises our equity section. Net income of $1,360 increased total equity to $5,860. Our total liabilities plus total equity equals $14,830, which equals to our total assets. Remember that on the balance sheet, total assets must always equal to the sum of total liabilities and total equity.